Today we are very honored to have Scott Lim, CEO of MIDF Amanah Asset Management, here to share with us about his company and also the strategy of his fund. So Scott, welcome.
Thank you.
First, can you just briefly let the investor have an idea of about your company and also your strategy looking forward?
Okay. Basically, the MIDF Amanah Asset Management started up about 20 years ago. It was previously known as C Crossroads Asset Management, and subsequently, with the C Corp left the joint venture partnership, it was taken over by the Amanah Group. So it was then known as Amanah SSCM, and subsequently with another merger with the MIDF and group, and that's just why now we're known as MIDF Amanah Asset Management. Right. This company has been in the business managing institutions' money since 20 years ago, and the last 10 years they have also been managing some unit trusts. However, it was previously owned by the eUnittrust Berhad. When 3 years ago, when I came into this company, I took over the eUnittrust business and merged it with my institution business. And currently, we are the owners of 6 local unit trusts, and we have just launched 2 regional unit trusts. Yeah.
Okay. So, as a whole, what is the investment philosophy of your whole team?
Yeah. The investment philosophy is very straight and simple. We are fundamentally driven. We believe in stock picking. We believe in doing primary research. We believe in seeing the companies, the management, filter the balance sheet, the P&L, the business model, and as well as, of course, the fundamental studies of the economics of the country and the countries that we the markets that we invest in. And at the end of the day, we are fundamentally a growth house, an equity growth house. And what we specialize in are the growth funds, and because of that, we actually use the very fundamental research processes, right? Top down and bottoms up, to pick the stocks and invest into the growth model that we position in. Yeah.
Okay, I mean, from an investor point of view,
yes,
of course, everybody wants to have growth in the investment.
Yes.
But on the other hand, we know that this is a two-way traffic, right?
Yes.
When you have the return, you also come with the risk.
Yes.
So how do you manage the risk side?
Yes, I think you are very right. Risk should be viewed in the context of the return. For example, what we advocate is that a risky investment is not risky if you are well compensated for the returns that for the risk that you take. So in short, for example, a growth fund, right, or aggressive growth fund, what we are looking at is that the volatility of the funds are definitely there. And what actually is more important is whether you are generating enough returns for the risk that you're taking, right? That is actually our emphasis on the risk parameters that we take. I am an advocate of equities, especially that if you believe in growth. If you believe that the growth of the companies will result in the higher earnings growth, and subsequently that will be filtered into the price growth, and that means the potential for capital gains. So in short, equities is represented by growth. If there's no growth, I think that the returns on the equities will be low, right? And this is why that I think the investors have to view in that context.
Okay, so practically,
yeah,
your funds, most of your funds, of course you do have money market fund as well, but for your growth fund,
yeah,
it's definitely meant for investors who are prepared to able to accept higher volatility.
Yes, true. Okay. Yes.
So looking forward, of course we know that now market is relatively volatile.
Yeah.
And looking forward, do you have any plan other than your current fund? Do you have any plan to launch any new funds?
Yes, we have actually just recently launched 2 new regional funds. They are the Asia Pacific ex-Japan growth fund. However, the strategy that we adopt for the funds are absolute return basis with a target of minimum 8% return. Right? Why are we using this Asia Pacific as a region to invest? Is because we are very, very bullish on the prospects of the Asia Pacific markets as ex-Japan. And we believe in the fortunes of the Asia Pacific being the epicenter of the wealth creation. Right? And therefore, if the wealth creation is going to be so tremendous in this region, and definitely means that you are going to see much higher earnings growth for the businesses that are here because there are greater demand for the products. And therefore, I believe that is what you call a virtuous cycle. You know, when you are actually in a booming region, not only that your companies will be doing well, including your assets prices will be doing well, and of course the investment will be also doing well. So what we have to actually look at is that the prospect that are relative to the developed markets now, the growth, the GDP growth in this region are actually 2 to 3 times higher compared to the advanced countries and the economies there. So they are all arguing for a major shift of the money coming from the advanced economies and markets to shift into the developing economies and market. And that is why we are seeing that we are in a huge cycle of early cycle of the re-rating of the emerging markets here. And therefore, I think that the launching of our funds are timely because I think that we are in the early stage of investing into this trend and into this cycle. Yeah.
Okay. There are a number of funds also looking for absolute return.
Yeah.
So can you tell us what is the difference between your fund, the way that you manage it, and other funds? Of course, it may not be fair for you to comment on other funds, but how do you manage your absolute return?
Okay. Yeah. Basically, absolute return strategy is different from the relative return strategy because we are not benchmarked against the market indexes. Right, such as that the MSCI Asia Pacific Index or your each of the country individual indices. So absolute return focus on alpha generation, right? And when I say alpha generation, that means as long as when I pick a stock to invest, the stock's returns in the futures is actually meet my targets and expectations, that means it is already worth investing in, regardless of what is going to happen to the market or happen to the index stocks, so that you don't use that as a benchmark. Okay, now come back to another way is that when we talk about alpha generation, we are talking about how can the business model, right, and also the management within the constraints of their balance sheet and within the constraints in the markets, such that how are they going to generate the higher returns using the limited resources that they have, right? It's basically very much organically driven, right? And of course, sometimes in the market, you might have a thematic plays or such that there is an immediate trend that is developing in the market, such that it will advocate us to actually shift some of our positions in the portfolio to capture this kind of trends, right? And that can be very, very lucrative sometimes. For example, let's say that there is a major earthquake in Japan, such that it has actually bring the valuation of the market down to very low level for certain sectors because of affected by the interruptions of the operations and so forth. And that will actually warrant us to take advantage of this kind of trend to actually position our portfolio for that kind of gains on the upside. So in the immediate terms, you can also say that we are dynamic enough to allocate our resources, our portfolio according to what we see is the best, the risk to take during that particular point of time. So that means that I can also take positions in the smaller cap stocks, right? I don't have to be index stocks, even that they are expensive. As what we know that some of the markets are, the blue chips are very high, right? Such as KLCI, right? They are already valued at about 18 to 20 times PE, which is way above the regional benchmark. So I will take the initiative is that I do not think that I want to be held hostage to the valuation, and therefore I do not want to invest in this kind of index stocks because purely from a value investing point of view, is actually a lousy valuation to get in. So I don't have to buy for the sake of buying, just like some of the index funds and some of the relative funds. Yeah.